Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.
Welcome to this special edition of the Sparta Market Outlook Podcast. While our weekly episodes focus on trading opportunities and short-term dynamics in the oil markets, today we're going to take a step back to examine the bigger picture that shapes these day-to-day fluctuations. I'm delighted to welcome Julien Mathonnière, economist at Energy Intelligence, where he leads their oil demand forecasting and macro fundamentals analysis. Julien brings a wealth of experience, having previously served as a crude oil market reporter at both IHS and ICIS. We will dive into the forecasting world of oil demand, which I have some experience in as well from a previous life, so I'm looking forward to dusting off that hat. With me, I also welcome back Neil and Phil from our Sparta team to the conversation. We'll do our best then to examine how these estimates, macroeconomic indicators, and the energy transition will influence market dynamics through 2025 and beyond. So welcome, Julien. Thank you for being with us on this podcast. Why don't we start with the fundamentals of how do we track oil demand? So Julien, in your experience, can you walk us through which statistics or data sets do you find most reliable and why?
Yes, let's talk about how we measure that oil demand, and maybe also of interest for your listeners. Let's figure out why it has become such a contentious and heated debate among forecasters, namely between the International Energy Agency and OPEC. Oil demand we primarily measure by monitoring factors like economic growth, transportation activity, refinery utilization across major consuming countries, effectively counting barrels used by consumers across different sectors. So for OECD countries, which is about 45% of global demand, data is compiled by the International Energy Agency. And although it is lagged by a couple of months, it's usually timely and accurate. For non-OECD demand, however, the remaining 55% or so of your global demand, it's another kettle of fish. Countries like Argentina, Brazil, China, India, they publish official data, but most other non-OECD countries don't. And therefore, your demand assessment becomes a vastly different exercise where intuition and judgment, as well as any available clues from the energy news, must be used as a proxy if you want to bridging the hard data gap. Absolutely. And of course, it begs the questions of reliability of proxies versus published data. Because when you start implying supply and demand balances from, say, trade or stock flows, then you may end up missing some barrels in your calculation. And the oil forecasting world has an expression for that. We call them the missing barrels, which is basically when demand has been underestimated or supply overcounted, or vice versa. So for example, during the COVID pandemic, we had unaccounted stock builds in non-transparent storage. And by non-transparent storage, I mean, for example, floating storage, tanker ships used as storage. We missed that. And all forecasters miss some of that. Like, the discrepancy where, if I remember well, between 1 and 3 million barrels, depending on forecasters, depending on data sets. So it was, a very very tricky moment. The problem is these discrepancies have pitched the IEA and OPEC on a collision course. On the one hand, you've got OPEC seeing, oil demand rising to over 120 million barrels per day by 2050, whereas the IEA sees demand peaking by 2030 at around 105, 106 million barrels per day. Now, what does it tell us about demand forecast? I think there are three main takeaways very quickly. One is that as a demand forecaster, you need conclusion first. I know it may sound a bit shocking to your listener, but it's an important topic, because depending on whether net zero emissions or maintaining the relevance of fossil fuel for as long as possible is your target, then your forecasting outcome will be vastly different. And so the reality of forecasting is that to a degree, the view determines the numbers and not the numbers determine the view. And that alone, if you think about it, would probably explain why forecasters like the IEA and OPEC are so polarized about demand. But hold on, that's not all. Your forecast is also hostage to your views on GDP, on economic growth. Let me give you an example. It's an example that I always give, but it's kind of telling. With global demand consumption at around 100 million barrels per day, let's make it 100 for the simplicity of the argument. At 100 million barrels per day, if you continuously compound that by a 3% annual growth rate over the next 10 years, then in 10 years from now, 2035, your global demand will reach 135 barrels per day. Yeah. If you compound by 4% instead of 3%, you'll reach 150 million barrels per day in 10 years from now. So this 15 million barrels per day, 135, 150, the 15 difference is huge. If you do the same exercise with a 3 and 5%, the difference over 10 years widens to 30 million barrels per day. So your views on future economic growth and on GDP growth can swing your future demand forecast a lot. And the last thing I would say is one critical area where assumption can be changed at will is China. If you think about China, such a big demand country, long-term oil demand in China, you can swing back at least 500,000, maybe up to 1.5 million barrels per day, either way, so plus or minus over the next, say, 10 or 15 years. And so, how can I say that? So many assumptions in the model, in your model, are subject to significant adjustment, but they are very difficult to defend to the death. Think of the shift from, motorcycle from cars in India, the rates of electrification in Southeast Asia, the switch to LPG for clean cooking in many countries. Biggest topic of all, the adoption rate of EVs. So in other words, you must ensure that your forecast and how you use those data set illustrates the impact of your assumptions regarding policy, technology, energy efficiency, demographics, and economic development. A solid forecast is not so much one that's accurate, but one that is able to tell a compelling story based on the data sets you use, basically.
So it's a full-time job. Oh, sorry, Neil, you carry on. I was going to talk about how granular kind of some of these models have got kind of over the years in terms of levers that we can play with. But Neil, what was your comment?
Very interesting. I was just thinking that you're talking sort of much more longer term, but these discrepancies that you've described between the IEA and OPEC, for example, those exist for demand forecasts, or let's say demand estimates for 2024 as well. That was one of the big themes of last year, that there was a huge discrepancy between some of these agencies. Is that still a problem? Can you kind of outline whether that's still the case and where the differences might have been? Because you talked about China already. We know it's a bit of a black box demand-wise. Is it largely China, or is it something else going on?
No, you're right to mention China, Neil. I think it's been the elephant in the room for everyone and for every forecaster. And the view about China and the view about where China's demand is heading is obviously very, very different between OPEC and the IEA. By the way, if you remember, slightly over a year ago, when the IEA and OPEC issued their demand forecast for 2024, they were different, but both had China's demand growth relatively aligned. I think OPEC was plus 630,000 and the IEA was plus 600. So, they were aligned. Yep. There was different forecast numbers, but there was some sort of consensus over China, which afterwards sort of broke down. Everybody started to disagree as the demand actual and macroeconomic indicators about China came in. So I guess there's two things here. One is that there's disagreement, I think, between forecaster and again, especially between IEA and OPEC about which amount of future economic growth will lead to higher oil demand. Where do you see the correlation of a relationship between economic growth and oil demand? the view from the IEA, the one that favors net zero emission scenarios, is that you've got other parameters, some of which are very difficult to quantify, like change in behavior, change in the electrification, of course, change in demand patterns across various sectors, but especially in the transportation and residential sort of sectors. So views about some intangible factors and how they may affect your future demand are very different between OPEC and IEA. And some disagreements, plus, of course, the view on Chinese macroeconomics has started to lead to diverging interpretation. Of course, there's over indicators. I mean, we can discuss that later if you want, but...
That sounds good. Look, thank you. I think you've kind of given us a bit of an insight in terms of the blind spots that some traders and some analysts potentially need to look at. You've also given me kind of fond memories of trying to scrabble around for Africa statistics back in kind of previous life. But look, if we move forward into the actual demand forecasting, so moving from the measurements of it into your forecasting, you've seen so many different methodologies, I'm sure, in your career for forecasting demand. So what are the good leading indicators for you that something might be going right or wrong, kind of certainly within your models as an example?
Maybe I don't want to jump the gun here because it's a topic that is very sort of pervasive in demand debate, but also in the macro demand sort of more granular product view. But I think straight away, I would answer, look at the diesel gasoil market. Sorry for jumping to the nitty gritty straight away.
That's great.
But one observation that came out from, conversation with a lot of people, sources, clients, watching the market comments from Sparta Commodities, is that this diesel gasoil no longer seems to reign supreme among petroleum products. I think first, it has lost its geopolitical premium from Russia's invasion of Ukraine. If you remember, shortly, let's say in the spring of 2022, after the war began, we had like those diesel prices shooting up to stratospheric heights. We came back from that, exactly. The market has sort of recoiled from those levels. The market basically has adjusted to the new trade patterns. And an increasing number of analysts, it seems to me, but maybe it's just an impression, they seem to see diesel as a proxy for structural demand changes. Why? Because gasoil is the balancing barrel in a refinery product slate. It sits at the middle of your crude distillation unit. So when you run crude in your distillation column, diesel is in the middle. It's the product around which refiners can move their cut point, like to use their jargon. Like, they can decide if they want to make more or less, and by making less, they can, redirect the flows to making maybe a little bit more of jet fuel, maybe a little bit more of bunkering fuel, like very low sulfur fuel or whatever. You can sort of work around this central diesel cut point. And the problem is, diesel is beginning to come under attack from both the supply and demand side. In the US, Europe, China, the world's major demand centers, Europe was the main diesel demand center. Diesel demand is peaking or has peaked or is showing signs of peaking, like in China. There is less diesel demand for power burn. I think natural gas and renewables are starting to take an increasing share of that market. European demand for diesel is also crowded out a little bit by increased demand for gasoline. As consumer, they switch from diesel car to plug-in hybrids, and most of those plug-in hybrids are running on gasoline. I know there's like diesel version, but the plug-in hybrid is like more a sort of gasoline battery combination.
That's certainly what I drive.
Out a bit of diesel. And yes, Europe was the biggest market for diesel cars globally, and there's a major shift towards alternative fuel. Certainly seen those headlines about LNG, power trucks in China, etc. So yes, I think diesel is a big topic, and it's an important market to watch. Very quickly, maybe the other indicator, the pace of the green transition in China. I was mentioning the LNG trucks, but it's simply staggering. And of course, it raises several questions about how the world gets used to oil demand growth without China, or at least with less China in it. For example, there are reasons to think that China crude imports might peak structurally. And it's not me saying, some investment banks have made the same observation because the Beijing government has put a ceiling of 1 billion tons per year. So that's about 20 million barrels per day on their refining capacity. And they're more or less there. I think refining capacity in China is probably something around 19 million barrels per day-ish. Yeah. Right now, you've got some new capacity coming online in this year and next year. So it means like if you put a ceiling at 20 MBD on that, you're not going to grow in terms of crude demand. So yes, that's certainly another factor to watch. And then you've got gains in efficiency, of course, which, as we mentioned before, point to a lower relationship between your economic growth and your oil demand requirements. And my framework, by the way, to think about this and to think about energy efficiency is beta. B for behavior, E for electrification, T for technology, and A for adoption of new standards. So for the geeks among us and for the geeks listening to us, it's a nudge to finance where you know that alpha is the excess return of an investment. Here, my beta is what drives excess GDP growth over all demand. So you're growing, your economic growth is faster than your oil demand growth. You know, it decorrelates. You need less oil to do more or to do the same amount of economic activity. And of course, these drivers, they sort of map out the sectors where the largest disconnect between oil demand and GDP is possible. For example, the road sector combines all four aspects of beta: behavior, car sharing, electrification, technology, lighter cars, new chassis, better technology, and adoption of fuel standard. In the past 10 years, I think the adoption of fuel standards in the US and EU have actually done more than the electrification itself. So
that's really interesting.
Think about your future demand.
Was it in terms of the efficiency of the ICE engines rather than? Yeah. Okay. Understood.
Correct. Absolutely correct. Yeah. Basically, you see more adoption of those big SUVs, which is like, we can discuss that later, a bit of a Jevons paradox effect. A rebound in oil demand because you can do more miles with a much heavier vehicles. Basically, you can do twice as much miles or kilometers with the same car today than 10 years ago. So, and I think it's even more important than the electrification trend. I mean, from my at least personal point of view.
No, that's great. Super interesting. I'm very much looking forward to getting into the EV conversation, the electrification, especially kind of in Asia. That is certainly a hot topic that we do get asked sometimes. But look, from our perspective at Sparta, we're typically looking at things like refinery margins, clearly kind of our open and closed arbitrages, going into typical demand centres, right into the short term as prompt indicators for demand. So how do you interpret that whole short term demand piece into kind of the long term forecast that you've got? How do you use that information?
I would also look, I would probably start looking at prices maybe as a third clue, that they've been sort of range bound for more or less the past 10 years. And all else being equal, they seem to point to the same range in 2025, despite, the tariffs, the geopolitics, the peace talks, what have you. And to me, it means that either demand is not great, or maybe supply is plentiful, or maybe both. So if we try to slice that out, one, non-OPEC producer are poised to add around 1.2 million barrels per day this year. You've got other forecasts pointing to 1.3, 1.4. That's the kind of range. But that tells you it rises faster than global demand. Our own global demand estimate for growth for 2025 is 950,000 barrels, so less than a million, basically. Yeah. So you grow more from the non-OPEC plus side than from the demand side. And if you remember, in 2023, non-OPEC plus outperformed after the US added an extraordinary, I don't remember, 1.5 million barrels per day, something in that region. And in 2024, it's demand that underperformed after China spectacularly failed to deliver the 600,000 barrels that some of the big forecasters expected.
Yeah, of course.
So that's one thing. The second thing is, meanwhile, OPEC plus still sits on at least 6 million barrels per day of spare capacity, possibly a bit more. I think they have an incentive to keep a price floor by essentially defending their budget break-evens. If you take like the trade break-evens of, I'm not talking fiscal or social, I'm just talking the point where you pay for your imports.
Yep.
Import export sort of balance out. Saudi Arabia, it's probably 76, 77. So, you want to maintain your price in the mid 70 range to manage your budget break-even. I also think the group is probably looking to gently add supply back in the summer, but it's going to be tricky. But we'll see how, a lot of moving part. It depends on geopolitics. It depends on those tariffs, the reaction of other countries. So many parameters, but it's still very in tension, it seems to me. And I think Trump 2.0, by the way, comes with a consolation prize for OPEC. Trump is calling for lower price, which OPEC may rightly seen as a green light, to add back supply, yet with a few caveats for the US, which is that if you depresses prices too much, I'm not sure the US oil producer are going to manage to, or will be willing to add a lot of production. Their break-even production price probably, I would say US shale patch, maybe 70, which is where we are now. It's fine.
Yeah.
But we were talking about pushing more oil production from offshore. And I'd say the break-even offshore is probably closer to 80, 85, which seems to me that Trump wants to eat his cake and have it. Like, he wants cheap prices for the domestic US consumer, but the viability of pushing more production from offshore depends on higher prices. So what do you want? More inflation, more US production? It's complicated to follow Trump's those days. But anyway, and my last point, last but not least, we've got more structural factors that get into the way of higher oil demand. So think that first, the world's two largest exporter, Germany and China, they're running out of steam. They're both looking for a new growth model, and they're large surplus countries. So it really matters in terms of, business confidence, generating more trade, etc. You've got global GDP growth slowing below its historical average of 3.5%. Magically enough, for the past half century, GDP growth has been half century, maybe a little bit too long, but at least for the past 2 or 3 decades, GDP growth has been around 3.5. I think we're going to sink below that going forward, at least in the next 2 years, probably after that. And yes, and there are creeping concerns about China, that may soon follow Europe and US in sort of peak transportation hole, which is not boding well for the oil market, basically.
Okay. Julien, thank you so much. Oh, sorry, Neil, carry on.
No, I just wanted to add something onto that. So interesting you talking about flat price as a indicator of demand, if you like. Let's just say it's a very poor one, because obviously flat price can be responding to all kinds of stuff. But one of the things it does respond to as well is signals from the physical market, which you would have indicators for using spreads. And just because we were talking about diesel demand as one of the main, or the diesel market's one of the main indicators, I'd say diesel spreads have been pretty good the last couple of months, right? Pretty strong. And there's a bit of an internal debate amongst us as to why that is. One of the reasons is there's lots of things going on geopolitically, of course. Nat gas is spiking. But one of the points I wanted to make was for the first time in several years, we actually are having a cold winter. That is a good chunk of marginal demand that is obviously just seasonal and sort of mixes up your message about where the economy is actually going, right? So the thing I've been having discussions with the last couple of days with some people is there is obviously lots of concern about the state of the German economy. And one of the indicators you can use is the trucking indices from the German government. And those are not looking great in February and sort of January and February, I have to say. They're not fantastic indicators of, let's say, the Jody data that eventually come out, largely because Jody includes gas, oil and diesel. But it'll be interesting to see, let's say, post-winter, what the diesel market looks like. So is it that this sort of short-term incremental winter demand has been the last thing to kind of hold the market up or not? We'll see. But it's worth thinking about it, taking a step back and saying spreads this quarter might have been good because of weather. And, in the summer, we'll get the kind of true reflection of where the gas oil market is actually at, and therefore where long-term demand is looking as well. Does that sound fair?
I agree with you, Neil. It's a very intriguing market actually, because yes, headlines are pointing to sort of disappointing diesel demand, sluggish industrial diesel demand, etc., etc. I mean, I'm sure everybody has seen those headlines. And on the other hand, technically Europe is still short diesel, so that situation has not really changed from since the immediate aftermath of the war in Ukraine. So technically, we still need to get some diesel from the US, from from the Middle East. I said diesel, I should say middle distillates, because it's also true for jet fuel probably. And yes, it seems this market is thawing. It's showing sign of weakness, but suddenly you've got a bit of seasonal strength. You see, or you hear traders being concerned about the very short-term availability on the supply market. So it seems that contradict those headlines or the prior signals. So yes, it's a market to probably follow closely, because it's going to give us a clue about what's going on with demand. Again, diesel is probably a very good proxy of the wider global demand picture, and especially in Europe.
It's been interesting for me over this winter, because we've been running our distillate arbs in the platform for just over 2 years now, and for the first 18 months of that, it was very rare to see the arbs into Europe consistently closed. But actually, as we've gone through this winter, where theoretically we should have had some, supportive factors, as Neil was talking about, from the cold weather, those arbs have managed to kind of go for longer than normal closed, without the kind of significant rebound. And we've seen that we've had a little bit of a kind of, these arbs have sat closed for a while, but then there is still, as we were talking about, kind of strength apparent from the structure on the distillate in Europe. So looks as though kind of maybe there is a recognition that maybe the baseline demand isn't fantastic, but in the short term we do need to kind of be ready to quickly fill these gaps as they come up through the winter. So maybe a more medium to long term, not great outlook, but with still being aware that we don't have access to Russian barrels at the moment. You do need to kind of fill these gaps as they appear through the winter.
Yes, I agree. And I suspect that matching your very, very short-term cycles of supply and demand is getting very tricky. Like, I suspect this is what we see a bit in the price. This volatility is like so many trade disruption, but that diesel has to come from elsewhere to refuel Europe. And matching those very short-term cycles, if I can call them cycles, is getting difficult, because a lot of frictions are getting into the way.
I think one thing to note as well is where we are on refinery margins, certainly as well in Europe now, compared to kind of when we started the tool 2 years ago, potentially. So that level tranche of domestic supply as well has been met from Europe itself, right? So we're deficit 100%, and we still need to kind of call on imports. So there is kind of a part to play there. We touched upon Europe in detail, especially around the distillate side. Are there any other regions that you are looking at currently, especially for this year, in terms of where you think demand might surprise to the upside or the downside?
We've been looking at countries where demand surprised to the upside in 2024. I think the biggest surprise of 2024 is that China only comes, at least in our ranking and based on our data, third in terms of demand growth. We've got China growing by a little over 100, I think we've got 111 for 2024, after India at 170-ish, 171, and Brazil at 140,000 barrels per day of demand growth 2024. Okay. To me, it's of particular interest because both India and Brazil are part of the BRICS group, which, as you may know, is spearheading the push for non-US dollar commodity payments, oil especially. China still makes up 70% of, I think, BRICS total GDP. But India comes next with 15%, Brazil next with 8, maybe 9%. And from now, it seems to us and to most forecasters that India will remain the fastest growing country in terms of oil demand, not only in 2025, probably in 2026, and we'll see thereafter. But, yes, it's taking over from China. in terms of growth, not in terms of absolute number. Of course, we are talking 5.5 million Brazil versus 16 million China. It's not the same magnitude, but in terms of growth, it's growing faster. And you've got an expected 190,000 barrels of demand addition in 2025 from India. So it becomes indeed the fastest growing country. With a few caveats, again, India's sensitivity to oil prices remains highly dependent on the availability of cheap supply, like Russian oil. So Russia comes back in the picture, and with those tariffs, maybe the risk of tougher enforcement of sanction against Russia, India could be at risk in 2025. And then also, a lot of bullishness around India's demand is built around, the growing mobility needs of a rising middle class. But if you look at small clues like passenger vehicle sales, for example, the rate of ICE combustion engine cars, so we're talking about, conventional car, the rate of sales, the rate of the growth has started to moderate as far back as 2013. It was double digit. It went down to 10% in 2013. Now it's growing at 7.5%. Okay, this is still huge. This is still huge, but it's still now, it leaves room for maybe an alternative energy demand trajectory for India. Maybe we should think of India as making forays into more renewables, trying to cap emissions, things like that. I mean, we have to be creative about, the way we think about India,
So one to watch on the policy side, certainly, then going into the longer term. Okay. So moving outside of, potentially staying in the BRICS, actually, we talked about kind of China throughout the whole podcast already in different guises. But the forecasting kind of the Chinese market has always been really difficult for the majority of demand analysts out there, for sure. What are the lessons that you've learned in terms of how do you look at China, and what are the key things that we're looking at here in terms of forecasts? You've alluded to kind of the outlook. We know that we've got capacity coming online as well, but is there any other snippets that you can share with listeners in terms of what to watch out for here?
So I can tell you about a crucial mistake I did in the past about China. That mistake was I did not stick to my idea that a regime shift was in the making in China, and that Chinese oil demand would effectively decelerate as a result. It's more like an economist maybe point of view, but complex systems like modern economies and like big modern economies like Chinese economy have no fixed cycles. Their histories do not repeat themselves. So you have to think that what you've seen in the past year may not repeat itself, given a lot of changing circumstances in terms of trades, in terms of economic growth, etc. The problem is, even when a forecaster has a contrary view to the consensus, there is a strong tendency to keep quiet and avoid being a maverick, because somehow it's better to be wrong with anyone else. And I think I may have done this mistake in 2024 by, I remember having discussion with traders, literally making fun of my initial Chinese forecast, which was low, but still not low enough compared with the demand actual we got for China in 2024. I was well below IEA or OPEC. I think we had 400, but 400 was still too high, right? A permanent feature of energy forecast is their over-optimism and inability to provide a firm views on turning point. We always miss the turning point. And that's a problem with China. We still make typical forecasting mistake with China. Like a lot of people look at China's apparent oil demand, for example, which is production. So you take your refining runs plus your imports minus export. I mean, you guys are probably familiar with this formula. But the problem, if you do that, it shows systematic surpluses, and one cannot assume that they go into storage. Because if you assume that, then basically in the past 5 years, 2019 to 2024, using an average conversion factor for the metric tons to product going into storage, China would have accumulating something north of 1.4 billion barrels into storage, which is just it's not credible. I mean, it's probably the amount of capacity they have right now, 1.4, maybe 1.5 billion barrels of storage. So, you have to be very careful about handling those data. But I would say maybe it's time that we think differently about China. I would say that's my main message.
Brilliant.
I think we've all had the experience of trying to make a Chinese balance work. I've certainly spent many months on it and gotten nowhere. And one of the problems is that statistics are not great.
No.
Right? There's worse, but they're not great. So one of the key ones just is that people like is just oil in versus oil out, and then try and figure it out from there. And even on that metric last year, you could obviously see that something was up in terms of demand, right? In terms of runs.
Yeah, well,
yes,
genuinely,
much sympathy.
Yeah, thank you for your candor on that one, and for the leading indicator into herd mentality as well. So I think we've all kind of shared a bit about that, certainly within our careers. But look, I kind of want to stay on the Asia piece. I mean, it blends into kind of Europe and the rest of the world, to be honest. But why don't we just move to energy transition? This is always a new difficult one, kind of for quite a lot of people to end up forecasting as well. But the role of renewables and EVs, Julien, what's your opinion in terms of demand around this?
So I think we have, well, let's make it simple. I think we have three items in this bucket. We've got one is EVs, electric vehicles, including electric vehicles. I think we discussed that before, excluding China. What's the picture outside of China? Because in China, it's going fast. But what is the rest of the world doing? A second one is probably biofuel. And I would say the third one is what does the supply chain look like for all the previous? What does it look like for EV, for solar, for biofuel, what have you? So long story short, EV adoption has not slowed on a global basis. So again, you have to fade the signal from the noise. Lots of headlines about EV sales decelerating everywhere, but if you look at a global level, it's not the case. I think a record 70 million EVs were sold globally in 2024, compared to less than 13.7 or 13.8 in 2023. Well, below. That's according to the IEA, the International Energy Agency. So that's nearly 20% of global sales at this time, 20% of global sales, EVs. And the expectation is that EV sales, even in regions like in the EU, especially in the EU, will accelerate again in 2025, because we've seen a lot of negative headlines about Europe. Europe making good progress, at least second best after China, but facing multiple headwinds. I think there's a bit of a more pessimistic, rosier outlook for 2025. I mean, 2024 was always going to be a slow year. I'll tell you what, because lots of people bought EVs in 2023 to take advantage of expiry subsidy schemes. Yeah. So, the subsidies have gone. Yeah. So suddenly you've got a drop. This drop was visible in 2024. So let's forget about that. Let's move into 25 and think about what could make it a better year. Like, those German cars manufacturers desperate to put new models on the market because they're struggling against Chinese competition. I don't know if they'll manage. That's another topic. But, certainly trying to resist to the Chinese. As for biofuels, I'd say, so also looking at Europe, but that's the case everywhere, I'd say mandates, hard mandates from governments are driving demand. So we are driving demand. Unfortunately, they're driving demand essentially in Asia, but they're largely stalling elsewhere, including in Europe. Europe leads the pack, or leads the way in terms of sustainable aviation fuel. That's one part of the whole biofuel picture. But airlines are still struggling to hit their targets. I'll give you a few very quick practical examples. The Refuel EU Aviation Directive is more restrictive than anywhere else in the world. I think it mandates 6% of sustainable aviation fuel blending by 2030. It's even stricter in the UK, which is a separate satellite from the UK, at 10%. But for 2025, the target is only 2%. So we're not there. We're not at the 6% yet. We're target 2025, 2% blending, with expectations, if you listen to people, to contact, to expert, of maybe meeting half of that. Okay. So half of 2%. And to give you an idea, in 2024, I think the blending rate was 0.6, maybe 0.65.
So quite a way to go.
Yeah, we're well below target. And as far as the supply chain is concerned, that was my third point. What does it look like? When, we discussed EV, we discussed very quickly SAF biofuel and China as well. And you can see that, because of its enormously dynamic battery and EV sector, China has already cornered the market, so to speak. They pushed the concentration of global car supply chains well beyond acceptable levels for the rest of the world, which is why you see those tariffs creeping up everywhere. It's not just the US, it's Europe trying to defend itself and to ring-fence its own industry from Chinese competition. But I don't think, protectionism is an entire different topic. We're not going to talk about it right now, but, will it work? It looks very uncertain, but everybody has seen those headlines about Volkswagen thinking of shutting down 3 or 4 factories for first time in 87 years. That's kind of crazy. Like, the German car industry is struggling. Meanwhile, brands like CATL, and BYD, Build Your Dreams, have a long leg up in the race for battery supremacy. Yeah. And it's hard to see how Europe or the US could catch up by just putting tariffs. Even if tariffs are justifiable for at least one reason, there is no reason for a country like China to reverse the free market distortion it has created when it joined the World Trade Organization. It built its EV industry behind large protective walls. Yeah. And the world has accepted that. The world has accepted that without saying anything. So maybe the tariff is kind of a reaction, and at least it's pointing to some sort of reaction which is justifiable. Are tariff a good solution? I don't know. I don't think so.
No, I think it'll serve to slow rather than to prevent to a certain extent. So, Neil, Phil, any comments? I've got kind of some wrap-ups, actually. I've taken a whole bunch of notes from that session, but Phil, carry on.
I would just have one, and it was something that I kind of always looked at when I was at previous shop. So when you talked, let's just pick one figure. You said this year headline figure growth 950, I think, if I remember correctly. Mm-hmm. How much of that is pure petroleum, kind of actual products that's coming out of the refinery, as opposed to when we think about, obviously, you mentioned kind of India, Brazil, biofuels. Let's say total Indian gasoline demand grows, but so does, let's say, the ethanol blend, or the ethanol blending mandate. So is that 950 kind of pure,
hydrocarbon
product demand, or is there elements of biofuels in that already?
So it's total liquids demand. Sorry, maybe I hope I didn't accidentally said something like crude or oil.
No. You didn't. That was just me clarifying.
A big chunk of it, of course, is crude for nearly, I would say, crude 500,000. That's my number. We don't see crude growing by very much than that. The rest is natural gas liquids and biofuel. So in the mix, I think my natural gas liquids NGLs are around 320,000 of growth. So the rest would be biofuel. So biofuel, little over 100 in terms of demand growth. Ish. Sorry, it's not super accurate, but 500, 320, and the remaining to 950 being biofuel growth. We start to have more granularity about biofuel, but we've included that in our model since only the past 2.5 or 3 years. So we're only beginning, to have like a precise sort of slicing of those different categories. We've always thought previously in terms of global liquids demand rather than having those categories clearly separated.
Doesn't seem like a lot, does it? 500,000 of crude. Compare it to what OPEC are holding back.
It's true. And on top of it, I suspect that when you look at OPEC demand forecast, it's really demand for crude. It does not include NGLs are separate. So, they're really thinking about crude, and they're really probably thinking about OPEC crude. So yes, it's a lot more bullish view than that. We are really at the bottom end of demand forecast spectrum, probably slightly even more pessimistic than the AA. Of course, it's all moving parts. It's changing. We've already revised up this month, accounting from, higher growth in Middle East, Southeast Asia, showing high growth ratio in specific countries as well. So, it's changing, but I will not definitely not align with OPEC. It sounds too high to me.
Brilliant. Thank you so much, Julien. So my takeaways from this, and I think it's a good note to kind of end on actually, is that anybody who's in the market of creating demand forecasts these days needs to have a pretty granular balance, because being able to kind of adjust to kind of a considerable amount of levers kind of around the world these days is going to be quite critical, shall we say. So I'm certainly going to be watching the policy changes in India, and obviously kind of the impact of the Russian sanctions kind of with potential kind of downside to India demand as well. China balances, goodness, that still kind of is we could talk about it for an hour, I'm sure. Still relatively a black box, and very much looking forward to seeing kind of where that shakes out this year for the majority of the analysts out there. And of course, back to diesel demand in Europe. We continue to talk about it weekly on the Sparta podcast. I'm quite keen to kind of push some of this back to James as well and get his views, potentially in IE Week next week, where we'll be going live with our podcast there. But look, Julien, thank you so much. That was absolutely fascinating. I could spend quite a lot of time listening to you, if I'm honest. And it will be lovely to have you back in the podcast again at some point this year, so we can kind of review where we've got to kind of on global demand, if that's okay. Thank you to Neil and Phil as well for joining in on the conversation, and thank you to our listeners for dialing in and listening to us. As I said, appreciate kind of this has been a slight focus on more the long-term trends in the markets, but it is quite critical kind of to understand the context of demand and how that plays into kind of our weekly market moves that we typically cover. Next week, our podcast will be live from IE Week with Felipe taking the host. So very much looking forward to kind of hearing what our insights are from the street during the week there. Again, thank you, Julien. Thank you, Phil, and thank you, Neil. This was a great one.
Thank you, Julien. Thank you, Rachel, very much so.
Thank you.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.